So we're going to spend the next half hour talking about the current market indicators that we look at, which are mostly option-based or have some option orientation to them. Just a quick background on our company. I started this as a research firm, actually about 34 years ago. Then we moved into managed accounts after having some pretty successful recommendations during the 2008 financial crisis. So we're both a CTA and an RIA. And then we also do a certain amount of option education, including mentoring. I'll come back to this later, but on this page, optionstrategist.com/MCM web, you can download the PDFs of this webinar. I haven't posted them yet. I'll do that as soon as we're finished today. And then we're also having a special that I'll talk about later. All right, so here are the four basic indicators, although there's a lot of other indicators that branch off of these. But the first and foremost is the chart of the S&P 500. I mean, that's the most important thing. If you're trying to predict the market and your indicators are let's say, bullish and the market's going down, then the market wins because it is the king of all indicators. But we'll also look at put-call ratios. We'll look at market breadth, where we have a option-oriented take, and then we'll look at VIX and the various volatility derivatives, see if they're giving us any clues. So there's a very important rule that I have, actually two rules, or two parts of one rule. First, oversold does not mean buy. So we haven't seen an oversold market for a while, but the companion to that is overbought does not mean sell. So we've been overbought in some ways, really probably since January. But obviously the markets continue to go up. So we wait for confirmed signals before we actually make trades, which means we'll never pick the exact top or the exact bottom. But you know, how many times if you try to do that, how many times you're going to be wrong before you finally hit it, you know, the one time. So here's a 2-year S&P chart. A couple of important things there. First of all, the bear market of 2022 started back at 4,800 on in January of 2022. This year, then we rallied, or late last year, we rallied back up to 4,800, bumped into it a couple of times here, and finally broke out. And this is the real breakout that's been, you know, in force ever since. There was a nice consolidation area there before that breakout. We had a 10% correction last October, which turned out to be a healthy thing. And this was that bear market of 2022, and now we're in a bull market. We did have also a consolidation recently, about a month ago or last month, between 51.80 and 50.50. So in my opinion, this area that we traded back and forth in for a while should provide support. If we fall below 50.50, then I would say this chart is taking on some negative aspects. Here's a 1-year chart, same thing. You can see the support area a little clearer here. Obviously, there's resistance right around 52.60, where we topped out actually 4 different days the last couple of weeks. And now today, of course, we were down a lot with the CPI number, although news events rarely coincide with real market turns. They may you know, promote one later, such as the you know, pandemic or something like that, but that was really more than a news event. This was CPI. I mean, it was 0.4 instead of 0.3. Hardly anything to go panic over, but obviously a large number of traders were banking on a rate cut coming up soon, and that might be lost at this point. This is that previous support area down around 4,800, but 4,800 is so far from here that I'm not really considering that as anything I'm relying on at this point. So we've made 22 new all-time highs on the S&P 500 this year since January, and we, as I said, we built up that 50 to 51.80 support area. So if closed below 50.50 would be bearish, but as it stands, that chart is still bullish. We've just barely pulled back to the 20-day moving average, and we're below it today, though. But we're still holding a core bullish position, which we basically had in place off and on for most of the time since last October. So we roll positions up. I'll talk more about that in a minute. So we roll our options up to higher strikes and take partial profits along the way. But in my opinion, we're still going to be holding this core bullish position unless 50-50 is violated. So we have another indicator that we can place over the S&P 500 chart, and that's modified Bollinger Bands. Bollinger Bands were invented by John Bollinger, and in doing so, he used the definition of volatility as being the standard deviation of daily price changes. And that seems reasonable, but in the math world, say Black-Scholes model and other things like that, they use a slightly different definition. They use the standard deviation of daily percentage price changes. That makes a little bit of a difference. And since we're in the business of our volatility is both realized, which is what this is, and unrealized or implied, those need to be lining up together. So we need to use the Black-Scholes definition. And so we look for the S&P to move outside of the plus or minus 4 standard deviation bands, and then move back inside, and that creates a signal. We have a further condition we place on that, and we call them McMillan volatility bands. So here's the last year with the bands drawn on it. You can see that the top band there is right here. That's plus 4 standard deviations, and just inside that is plus 3. So you can see that we moved outside here and back inside, but then back outside again. So that stops that signal out. But this one, we moved outside and then back in, and then all the way down and hit the lower band, and that's where we take a profit. So the red letters here are successful signals. Blue ones are unsuccessful, although they're stopped out fairly quickly. You can see these buy signals in August, last August, during the 10% correction. There was a buy signal right here, and then another one right here. And they got a little traction, but not enough to reach the upper band. Finally, this one did. We bought it here, and it reached the upper band there. We haven't had a signal on this thing really this year at all. We've had some setups, but no signals. And so right now you can see the plus 4 standard deviation band is well above the current prices. So I don't know if we're really going to get this signal anytime soon. But there's that support area again there. We can do this same concept on any stock, ETF, futures, what have you, and we sell that as a service. If you're interested, you can. It comes up on TradingView.com, and this is just the S&P chart. It shows you buy and sell signals. Those are the same ones we were just looking at on that previous chart. Anyway, let's move on to the second subject. That would be the put-call ratio. So to predict the broad market, the S&P 500, we use the equity-only put-call ratio. That's all stock options that trade, and I'll show you why in a minute. Put-call ratios as an indicator were invented by Marty Zweig back in the 1950s, and he would get the option volume out of the Barron's on Sundays when the various put and call dealers ran ads, and in the ads they tell how many puts and calls they traded. And he soon realized that if there was a lot of put buying going on, the market went up. And if there's a lot of call buying going on, the market went down. So it's a contrary indicator. We're trying to decide, when is there too much bullishness? When is there too much bearishness? And of course, that's the hard part. The simple put call ratio that Marty looked at is this. Let's say it's IBM. At the end of the day, we sum up the volume of all the puts that traded in IBM. Separately, sum up the volume of all the calls, divide the two, and that's the put call ratio. Now, the ratio moves opposite to the stock price. So if there's heavy put buying, that makes the numerator of the fraction go up, and so the ratio goes higher. But when is there likely to be heavy put buying? Well, that's when the stock is going down. Conversely, heavy call buying, so if there's an increase in the denominator of a fraction, the fraction drops in value, the ratio goes down. And when is there likely to be heavy call buying? Well, that's when the stock is going up. So when we publish on our website in an area called the Strategy Zone over 1,600 put call ratio charts every day. We use a moving average on the put call ratio of 21 days, just in case there's something to Fibonacci. And we typically would show, well, not typically, but we do always show the put call ratio and the stock price so that you can get an idea that if they should be moving in this inverse fashion. Let's see, just hear how it works. The stock's moving down, and as the stock's moving down, people are buying puts, forcing the put call ratio higher. Eventually, the put call ratio tops out and forms a local maximum, and that's a buy signal for the stock. So now the stock starts to go up in theory. Move over to the left side. The stock is still going up. As the stock is going up, people are buying calls, forcing the ratio lower. Eventually, you get a local minimum on the put call ratio, and that's a sell signal for the stock. So that's what you would look for. Sometimes that's not there. Like arbitrage, other things can force a distortion in that. But if you have that inverse symmetry, that's what you really want to see. So this is not a current chart, but this shows on the top, the S&P 500 index, and on the bottom, the equity only put call ratio, all stock options that trade over all the US exchanges. I think there's like 9 of them now, maybe more. Anyway, you can see the inverse symmetry that exists most of the time, and that's why we use the equity only put call ratio to predict the broad stock market. So where are we today? Well, let's just go back a little bit, and I'll just show you here. We had a local maximum last October. That's a buy signal. It was just a bit early on this one, but then turned out to be a really good buy signal. We had a local minimum in January, and unless you were shorting IWM or some small cap index, that didn't work so well. But we did have returned to a buy signal, and now we formed this local minimum, and we were kind of wiggling around here at a low level, and now we've finally broken out. And to me, that's a confirmed sell signal. So we have a sell signal from the standard equity only put call ratio. As computers came along, we were able to make this calculation. It would be hard to do by hand, but let's say at the end of the day on IBM, we take every option, we take its closing price and multiply it by the option volume that traded that day, and that gives us the dollar volume for that option. Then we sum up those dollar volumes for all the puts, sum them up for all the calls, divide the two, and that's the dollar weighted put call ratio. You could do this on a trade by trade basis, but that's an expensive piece of data to collect, and it turns out this has proven to be just as useful. So we're measuring now the dollars being spent on a bearish opinion versus the dollars being spent on bullish opinion, not just the volume of options. And while the signals occur about the same place, they're usually a little more extreme. So for example, last October, as the little correction in the market was ending, this was a ratio that was the highest it had been since the pandemic lows in the market of March 2020. In other words, a lot of pessimism at the end of this October 10% decline. Then we launched to the upside. Again, we had this sort of false sell signal there beginning of the year, which reversed itself. And now we've come back down. Again, we're meandering at very low levels. These were some of the lowest levels since November of 2021, before the last bear market took place. So a lot of optimism now. So we moved from extreme pessimism up here to extreme optimism down here, but that's the way the market works. And now this ratio has finally started to move higher. And again, that's a sell signal. Meandering along at that low level did go to local minimum, which technically is a sell signal. But if you were following us in our newsletters, we said we wanted to see it actually break out and start to accelerate to the upside, which it has done. And so now we have a sell signal from this too. So these put call ratio signals are intermediate term signals. Usually you just get a few per year. And, this is a new sell signal, so we are paying attention to that. And we've taken positions in alignment with that as well. So what do we trade when we get these? We have a McMillan volatility band signal or put call ratio signal. Well, I usually trade an option whose delta is slightly above a half, closer to 1 actually. The delta of a call option, for example, ranges between 0 and +1. 0 meaning it doesn't move at all when the stock moves. one means exactly as much as the stock moves. We don't need that much of a high delta, but I do want to have a modestly high delta because we're in the business here predicting the underlying. And if I'm right on the underlying, I don't want to be wrong on the option by buying something that's so far out of the money that it doesn't move, even though I was right about the direction of the underlying. So for SPY options, which we typically buy for these kind of signals, we'll buy one or two strikes in the money with a delta 0.70. If we go out a little bit longer, maybe for a put call ratio signal going out, excuse me, 3 or 4 months, we might buy an at the money option, but that still has a delta slightly larger than a half. So we're going to make money if we're right about the direction of the underlying stock by buying this type of option. Yes, there is some loss to time decay, but we're looking to capture a good portion of the move in the underlying. Now on TV, they are always spreading the options, the bull spread. So if they're bullish, they'll buy a call at this lower strike, and they'll also sell a call at the higher strike. Well, between the two strikes, yes, you make profits as the stock moves in your favor, but eventually you hit this higher strike and your profits are capped off. So I don't see why you would want to do that. The only time that even makes any sense at all is if the options are quite expensive. And we publish free volatility data on our website every day, so you can check to see whether options are expensive or cheap. In any case, this compares the bull spread, the spread, the black line, with actually just owning the call. Now, a lot of times these guys will say, well, it's cheaper. It's not cheaper. You're risking 100% whether you buy the call spread or buy the call. So you might, dollar-wise, yes, it could be a few more dollars. So instead of buying, let's say 5 spreads, just buy 4 calls if you're really concerned about the dollars. And even if you do spread, you can mitigate the negative effects by A, widening the difference in the strikes, and then B, rolling your spread if you hit the strike. So right now in SPY, we're not spreading any options with an expiration of earlier than May 5th or May 5th or earlier. But if we are out to May 12th or later, we are using some spreads 15 to 20 points wide on the calls and a little bit wider than that on the puts because of the puts are more expensive than calls relatively in or out of the money on the S&P and on SPY. So this is just an example. Say we put it on a May 520, 540 call spread with SPY at 520, and we're fortunate enough to see the stock go up to 540. Well, at 540, we're about to cap off our profits. Yeah, there'll be a little profit left, but we're for the most part taking everything out of the spread we can at that point. So sell the spread you own and buy a new spread with higher strikes, and you can continue to do this along the way and keep your upside having some more profit potential than just being capped off. So just a couple of individual charts. This is one that we're just issued a sell signal on over the weekend and to our subscribers. You can see on the individual stocks here, this is WTW, which is now Willis Towers Watson. It used to be Weight Watchers, I think. Anyway, you can see that the buy signal last summer was a good one, and now we've come down, way down here. And but by the way, 30 means that $30 are being spent on puts for every $100 being spent on calls. So people are very optimistic. They're not buying many puts, but you can see the ratio moved up and then again there. So it's kind of a double sell signal. And a lot of times we'll also incorporate technical analysis. So we were waiting for this trend line or the support level to be broken, which it has been. This is gold, a couple of really nice buy signals, and now a new sell signal. So that one might be worth watching, although you can see the price of the stock is still just shooting higher. Might wait for some sort of higher high, higher low setup there before you jump in on the short side. CSX Corp similarly broke a support level at about a month ago, and now has been moving down in relationship to the put call ratio sell signal. We also can do this with futures options. Now the chart here, this is cattle, and this put call ratio chart is drawn using the cattle options that trade on the Chicago Mercantile Exchange. If you want to trade this chart, you're going to have a futures account because there's no ETF that simulates cattle. But also, we just recently had a buy signal in corn. And again, this chart is drawn using the corn options from the Chicago Board of Trade. But in this case, there is an ETF, CORN, and so you don't have to have a futures account. You could trade options on CORN, which CORN chart and the continuous chart of corn futures are exactly the same thing. In fact, the CORN ETF trades the futures. So moving on, the next indicator we look at is breadth, and there's a couple of things you can do with breadth. One is to keep a cumulative total of advances minus declines, and the other is to create an oscillator. So we do create an oscillator, and you see it says stocks only. That means instead of using New York Stock Exchange data, we're using the data on all optionable stocks. So the red area is overbought. You can see we got very overbought as we broke out, over those 4,800 level this in January, February. But then things have backed off some, and we actually went from being overbought. Remember, I said overbought is not sell. We went from overbought back down below overbought, and that is a sell signal as of last Thursday, April. I think it was Thursday, no, maybe, last week, April 2nd, was the sell signal for the breadth oscillators. That's still in effect right now. This is probably our flakiest indicator in that it can whipsaw back and forth, but obviously today breadth was very negative, and so that sell signal is still quite very much in effect. There's another thing we look at is cumulative volume breadth. That's the volume on advancing stocks minus the volume on declining stocks. And that has made new all-time highs 13 of those 22 days that SPX has. So there's not a negative divergence from this indicator, which is probably, I wouldn't say it's a buy signal. It's certainly not a sell signal. And typically, at a major top, we would get a divergence here. So there could be more to go on the upside, is all this is really telling us. We also track new highs versus new lows on the New York Stock Exchange. We got a buy signal back in January when new highs, where's my pointer here? When new highs outnumbered new lows for 2 days in a row, and there were more than 100 new highs on both days. That's been in effect since then. It would be stopped out if new lows exceed new highs for 2 consecutive days. That hasn't happened. There happened on one day a couple of times, but not 2. So right now, that's still a buy signal. And then VIX. So VIX has received a lot of criticism in the last couple of years, but really there's nothing wrong with VIX. Realized volatility just hasn't been all that high, so implied volatility is not going to be that high either. And there's a couple of things we can do with the VIX chart. One is look for spike peaks, and another is to look for the trend of VIX. So here's the current chart going back a year, and those B's there are, those are spike peak buy signals. They last for 30 days. And when there's a red one, that's a success. If there's a gold one, or that just means, or an orange one, that just means the second signal occurred within the 30-day time span of the first signal, so we don't take them both. And then the blue one is a losing trade. So that's been pretty good. We haven't had a spike here. And even today, with the market down as bad as it was, VIX did not spike up. VIX ended on the day at 15.5, up 82 cents. So, not a big deal at all. The trend of VIX, however, encompasses the 2 moving averages, the 20-day and the 100-day. And so here's the 200-day. And the 200-day, if the 20 crosses above the 200 and VIX is above the 200, which is almost a guarantee that's going to be the case, that would be a sell signal. So we had a mini one of those last October. It was quickly reversed in November, and we've been on, a positive trend since then. And all this means is that if VIX is low and it's not trending up, then everything is good for stocks. Now, Basically says that. So you can't trade VIX, but you can trade the VIX futures. So we look at the term structure. Here's the term structure of the VIX futures sloping upwards. That's what you normally see in a bull market. That's what we're seeing right now. In a bear market, though, they slope downwards. And the last time that happened to any significant degree was March of 2020, which is obviously extremely bearish. But here's the current term structure. These are the prices. I took these this afternoon right around 3 o'clock. And you can see the various VIX futures prices. Each one is higher than the one above it, except this one. We'll talk about that in a second. And here's the premium to VIX. So here, 1586 minus 1620 is minus 34 cents. So we don't really like to see that minus number in there, but the others are all nicely positive. So this is mostly bullish with the term structure sloping upwards and mostly futures at a premium. Look at this thing here, though. So the October futures, the futures are based on SPX options that expire the next month. So here at the bottom it says, those April futures are based on May options. Well, these October futures are going to be based, they are based on November 24 options, and of course that's after the election. So these options, the options closest to, but just after a volatile event, are going to be the most expensive options. In this case, November SPX options are quite expensive. We're looking for, I don't know what, but volatility around the election, that's for sure. So that's too far away for us to trade right now. But as we get closer, we may try some spreads or some things in there to try to take advantage of that. So the CBOE, in addition to the futures, the CBOE publishes these various volatility indices: 1 day, 9 day, 30 day is VIX, 3 months, 6 month, 1 year. And you can see here, for the most part, again, the term structure is sloping upwards. There is this little tiny inversion right here. I'm not sure what's happening in the next 9 days, but there's a number coming out that has got that a little bit inflated. But that's not really. That's just a tiny warning sign. So again, what we really look at here, and if you want a short-term indicator, is the price of the front month futures versus the second month. And there's not any problem unless April were to trade above May. That hasn't happened yet. So where do we stand here? So we have two bearish indicators. We have the equity-only put-call ratio sell signals. We have the breadth sell signals. We don't have a signal from the trend of VIX. We don't have a signal from the McMillan volatility band, and we don't have a spike peak signal. So those are out of the picture. The S&P chart is still bullish, in my opinion, as I said, unless it falls below 50-50. The new highs versus new lows, we saw that's still bullish. And the construct is what we just looked at. That's somewhat bullish as well. So this is kind of a neutral picture, but the core position is still there. So we're maintaining this core position, although right now our core options have fallen out of the money, so they don't have a huge delta on them. And we are trading other signals around that. And we roll our options up or down, puts down, calls up when they get deeply in the money, which in my opinion is 8 points for SPY. So we're back to this offer, our top 3 newsletters for $99. You can take them all at once, or probably better space them out a little bit. Just tell us if you're interested. If you go to that website, you can look at our track records of our various newsletters. Here's our DVA. This is from this morning's report. You can see that we've done very well in this bull market, and now you can see that we just recently put on these 2 bearish positions in the middle there, one based on the equity only put call ratio, and the other here we are, and the other based on the oscillator sell signal. So again, if you go to that MCM web, you can look at those things. We also have a couple of other newsletters. We have a new website. And if you're interested in money management, the way to contact us about that is the bottom email address, or that's a URL, sorry. And I should mention that our minimum account size is 100,000 for managing money. So I think we're just about right on time.